Great. Good morning. I'm Julian Treger. I'm the CEO of CoTec. CoTec's an ambitious new company which aims to reinvent the model of the mining company for the 21st century by using disruptive technologies and waste.
Julian, good to see you. Good to see you, sir. It's been a while, and here we are in a new guise as well. Might be worth introducing yourself to the folks. Perhaps they may not have come across you before. Where have you been? What have you done?
Sure. I don't know how far back you want to go, Matthew. I was born in London, but no, I grew up in South Africa. I was educated in the US. Started the first activist fund in the UK, and then I morphed into natural resources around 2005. And since then, I've invested in a number of projects. We've invested around $500 million, and we've turned that into around $3 billion in coal, in copper, and I also, along the way, ran a company called Anglo Pacific, now Ecora, where I took the earnings from around $5 million to over $100 million during the 8-year period. I was the CEO. But when we sold our last copper business, which was called Mantos Copper, into Capstone, that was something we paid something like $300 million for, and now that stake's probably worth around $3 billion. I left the UK anticipating some of the issues which have arisen over the past couple of years with regards to gains and non-doms and everything else. And I just had to decide what to do next. And it struck me that there were two ways to really make money in the mining sector. One was to buy things very cheap. And what was cheap and what continues to be cheap today is waste. So that's a big focus for CoTec. And the other thing was the way in which technology is transforming the world, but the technology hasn't transformed the mining sector, despite the majors spending billions of dollars over decades on research and development. Things are still done the way they were done 50, 70 years ago. And so combining those two, we formed CoTec. I had a colleague who had a shell company in Canada. The shares were trading at 12 cents. Today they're 10 times that, but I think they're going to go up another 10 times from here. It was a clean shell with $90 million of tax losses. So we took it over. We got a great board on board with us, and we started to look for technologies. And one of the directors is somebody called Tom Albanese, who ran Rio Tinto. And Tom introduced us to John McGar, who ran Rio Ventures. And with John, we looked at 400 different technologies around the world, and we've ended up investing in 6. But those technologies are the means to an end, which is to, hoover up 30 or 40 waste sites around the world where our technologies are the unique key to unlocking the metallic content of those sites.
Right. Okay. A lot to digest in there. And so we'll start with the first bit, which is you looked at 400 technologies and sort of settled on 6. In what form? Have you JV licensed? Have you bought and acquired these technologies?
So they're different forms. I mean, first of all, we decided in the end not to invest in, Silicon Valley transportation of general technology into the mining space. So we've ended up investing in new process technologies which answer the historic questions of the mining sector, which is what to do with hard materials, what to do with very fine materials, and what to do with very low-grade materials, which are the characteristics of what the miners left behind. So it works very well with dump reprocessing. And we own different stakes in those technologies. Some we are driving them in collaborations, so we have the rights. Others, we just have the rights, the licenses to the technology exclusively for certain commodities, and then others, we're shareholders, but with some, again, rights to apply them on a preferred basis to assets.
Right. So each one of these technologies does something different with waste products, depending on the metal and the different type of rock that you'll be dealing with. So Is there kind of one that you're leaning towards when you're going out looking for assets because there are more of them, there's better margin, or how you kind of value the opportunity?
Yeah, so the basically leaving aside the magnet business, which we can talk about separately, which is
Mm.
very interesting and very current at the moment. We've got technologies for iron ore, for copper, and for metallic waste. Those are the three verticals. And in due course, we will create CoTec copper, CoTec iron, and CoTec metallics. So for iron ore, we have technologies which can concentrate, particularly fine materials, and then pelletize fine materials. So those are the main technologies for that. For copper, we have technologies which can crack open hard rocks and then leach super low grade materials very successfully in a way that other technologies are not doing. And then for the metallics, it's really the concentration and pelletization technologies which we've got for iron ore, which we can apply also to metallic waste like tungsten, manganese, vanadium, nickel, tin, etc.
Okay, so these six technologies owned, or say influenced in different ways with either applications to certain metals or jurisdictions, presumably, and others will do too, but in different parts of the world, right? So, okay, got it. With the identifying of undervalued assets where these technologies can actually be deployed, are there kind of economic thresholds that you look to, or do you need to kind of prove yourselves first and you'll worry about the quality of the asset later?
Well, I mean, the technologies are quite proven. So we never invested in lab stage technologies. We've invested in technologies which are quite well advanced, and then we help the technologies as well, scale from like a TR5 or 6 to TR9. So we're assisting
What what's that mean in English for the regular
well, it's
punter?
where they've had some successes, in a laboratory or at a bench scale, but they're now doing pilot plants and they need to grow to be more commercial. So that's what we're looking at. We're not, investing in science experiments, and and then we are not really so trialing so much. The technologies obviously don't work in every single instance, but they work in many more instances than other technologies. So when we understand what works best with the technologies, that can inform what we are looking for in terms of the waste or the tailings or the heaps that we are searching for. So we have various geological criteria which we are looking for in terms of what's going to fit with our technologies.
Okay, and just so I want to be really clear. So, okay, these aren't science experiments. People have, cracked the code, as it were, but not necessarily the economic code by the sounds of it, because or they'd be doing it and selling it themselves. So, are you bringing money to the table for some of these people? Is that what?
Well, we've been investing in the technologies, like alongside venture capitalists, or we're funding development. Most of the technologies use a licensing model, but we're not interested in the licensing piece. We're really interested in, taking the license and applying it to assets. The technologies themselves have considerable value, and they've gone up in value. Unfortunately, none of them have fallen over. So that already underpins the value of CoTec. But the main focus is really not the technologies, but the assets, which is where we're going to be creating the vast bulk of our value.
Right. Okay. And okay. So I guess the important bit for you then is identifying waste material and doing deals and transacting with the owners of that, whether they see it as an asset or a liability, and work out what the recovery rates could look like and whether your technology can be applied to that. So how do you go about identifying those?
So, I mean, we have effectively now already 5 assets which we are working on, and we hope to announce a copper one shortly. So we have 2 in iron ore and then 3 which we're developing for the magnets. So in iron ore, the first example was referred to us by the government of Quebec. It's the old tailings of a mine which shut down in the 80s called the Cartier mine. It has around 120 million tons of tailings. We have agreed to buy the site for $2 million. And we have in the process of, we've drilled it and we're doing a new feasibility study. I think the NPV of the site will be between 130 and $150 million with $60 million of capex, which we can get from the Quebec financiers. That's the sort of model that we are looking to replicate and roll out, across Canada, in the US, and in Brazil. So that's one example that we think we can cookie cutter. But what's interesting about that is, A, the acquisition cost is very low. B, the government of Quebec has a $200 million rehabilitation liability on that site. And by the time we're finished doing the retreatment, it will be worth well under $100 million. We'll save them $100 million. So how do we divide that? And that's why in Canada, where there's over 10,000 closed mines with trillions of dollars of liabilities, which the government can't afford, this is a really great way to make things better, clean up, disaster zones, save rehabilitation costs, and actually create lots of metallic material that's valuable. Here at Lac Chenin, it's 68% concentrated iron ore, which can help the West develop.
So what you're saying is that there are various funds in Canada available to you who help you with the kind of the capex component, and I guess initially the opex elements too. You have a discussion with whoever's got the liability and say, maybe if we can save you some, can we split some of whatever we save you? And you'll extract metals from the ground. There are multiple revenue streams.
Yes.
Are there? Right. Okay. Interesting. So, right. Okay. For you as a business, do you imagine having to, or do you imagine being able to do this without raising equity at all for some of these projects?
We're gonna raise, but very little equity. I mean, the board and myself, we own 60% of CoTec, and we are interested in making another 10x on our shares. So the business is now worth, 130 million Canadian dollars. It can be worth over $1 billion easily, and that's what we're focusing on. So we don't want to issue too many shares at such a big discount to the existing sum of the parts. So we will issue shares, but we're never going to issue 5 billion shares and have a 50-cent share price. It's not what we're interested in. We're not interested in earning salaries or having an empire. What we're interested in is becoming, incredibly rich.
No salaries.
Well, no, I mean, we get salaries, but we're not charging huge salaries. We're not, it's not a job. It's an opportunity to create enormous capital gains. That's really our focus.
Okay. And in terms of competing capital allocation across multiple development timelines with all of these technologies and whatever you've got in front of you, and I guess you are incentivized to reduce the equity component initially.
Yes. So we're gonna, and most of the money we're looking to raise will be at the asset level, not so much at the CoTec level. Where CoTec's going to be focusing is like buying the Lac Chenin site for $2 million and then bringing in an investor at $60 million or $70 million. So it's a sort of incubator of the asset value creation, and then we'll have marks at the asset level to show how much value we've created. So, for instance, another one of our assets is an iron ore deposit in Minnesota, which we sort of invested out of bankruptcy. It's got 2.6 billion tons of iron ore. It's got tailings. It's got a concentrator, and we're close to buying a pelletizer. We paid very little for it. I think the NPV is $1 billion. CoTec has 17% of it. And we'll look to raise money for that project at maybe $400-500 million equity value. And that will be reflected in what CoTec's value is. So that's the model, to do it at the asset level where you don't raise money at a 90% discount to the sum of the parts. Maybe you do it at a 30% or 40% discount. And that way you can demonstrate how much value you are creating.
Okay, and are there any chances to evaluate kind of cross-platform synergies? In terms of, I don't know, binding solutions and salter being integrate into like Janine, for instance. No, that may
Yes,
not work.
well, those are the technologies for Lakshmi.
Oh,
And similarly,
accidental.
Similarly, we could use binding
Okay.
solutions at MagIron. MagIron has its own technology for concentration, like Salter, but for its particular type of metallurgy, which is hematite and goethite, and so on. So yes, I mean we are looking how we can flexibly adapt these. But the magnet technology is completely different. So that's something which is very current. That's a technology which was developed by Birmingham University over a decade at a cost of over $100 million. And it's a very neat shortcut way of taking old magnets and making new magnets from them using e-waste before it's shredded. And the economics there are very, very interesting. And this is an area which is very strategic now because of China. The Chinese have created a blacklist of American companies related to the defense industry, which they will not supply magnets to. And so, to the extent we can plug that hole, it's something which is very, very interesting. And we are looking at having 3 hubs there in the U.S., in Texas, Nevada, and South Carolina. We own 60% of the U.S. business, and each hub's worth around $600 million.
Today, it's worth each
Well,
worth 600 million.
The NPV of each one is
Right.
600.
Okay. Yeah.
We're building
Okay.
the first one, and will come into production in 27.
Right. Yeah. And which I guess leads on neatly to the next thought I've had, which is regard to the how do you internally how do you assess each technology's readiness level, or is there a sort of benchmarking system in terms of that de-risk deployment sequence as you try and roll all of this out? Because it's still a relatively small company, not a lot of people today. How do you control all of this?
Well, I mean, you can benchmark the technologies. As I said, there's a system of these readiness levels, which go from, I don't know, 1 to 9. So you can grade technology, and you can see how it's moving along its path. But as I said, we look for technologies which were well developed, which we could see working, which we didn't think were that expensive, and which could be category killers. And so we are very happy with the way in which the technologies are rolling out alongside the assets that we're finding.
Right, and the people within the technology partner again do you have a say in terms of how they are managed, or how they operate, how they process, and how they report on your assets? Because ultimately, they could be very beneficial to you. They could also be damaging if they don't do things the way that you want.
Well, we sit on a number of boards and advisory boards of the different technologies, and also with the magnet technology. It's a joint venture, so we work very closely with our partners. So we are engaging all the time and checking on how they are progressing. I think the case of the Salter technology, that's something else, because it's very well established. It's been rolled out already in technology in commodities like tin and nickel, but we have the rights for iron ore. So that's something which is already commercialized.
So in terms of there's no sales process for them, because you will be owning or have optioned the owning of these waste products. So that's I guess good. How do you kind of build this up? Because you talk in some of your marketing material about revenue within years, not decades, right?
Yes.
So you're assuming this thing all runs kind of smoothly and it's easy to do, and it's not really mining as a result.
No.
So how do you again manage that process?
Well, it's a much quicker process, but we still have to go through it properly and do the proper feasibility studies, and the environmental impact assessments are hopefully much less, because it's often brownfield restarts. But we're on track to generate our first revenues in 2027. And that would be from the magnet business. And then as we roll out the magnet business to other sites, and we bring Lakshmi on site in 28, we'll have many more revenues, and so on. So we're in like a factory. We find the opportunities. We have to do some work on them, and then 2 or 3 years later, they start to produce revenues. That doesn't sound very quick for the common, investor, but in the mining sector, where on average it takes 29 years from the discovery of a site to bringing it into production, it's warp speed, and so we think this is a very important area which can help the West generate the strategic materials that it needs in this global battle, much more quickly than alternative sources of mining.
And tell me a little bit more about the share revenue of the revenue sharing agreement, in the sense that you've got these tech companies who are small, need a little bit of help for you in some cases. You sit on the board of all or most of them. Are they sharing in the upside at your asset level, or are they expecting management fees, licensing fees all the way along? You got to make sure they're still in business, be able to do business with you down the line, right?
Yeah, so in our case, it's generally a royalty structure or a licensing fee. In other cases, they may just be being paid a licensing fee. I think they do different deals depending upon the circumstances. But we'd be also happy for them to put money in when they can into some of these assets and own part of the assets in due course. But most of them aren't in a position to do so yet.
Yeah, but therein lies the challenge, and I guess the onus on you to make sure that they are still around. Because I've spoken to technology companies in this space for the last 15 years, and very few go on to be huge and successful. They kind of get by. One, because there's a lot of competition. Two, they're not very good at marketing. And three, sometimes something comes along and you search them. So, but for you, so how do you continue to manage whether their product is the best on the market, and whether or not they are in a fit financial state to be able to continue to deliver for you on your projects?
I mean, we're shareholders, so we support them if necessary. So, I mean, there are some fundraisings going on now with some of these technologies which we're participating in. So, it's in our vested interest to make sure that they move forward. But they're also looking, and I think the market for technologies in the space is changing. So I think they're also looking, ultimately, you may start to see a range of IPOs or sales of these businesses. So yeah, I think as I said, they have considerable inherent value themselves. But for us, they are really the means to the end, which is these assets. And as I said, we have 5 assets, and by the end of the decade, we'd like to have 20. And that's the way in which we think over the next 10 years, we'll be able to build a new model mining company, which is much more nimble, low cost, and uses technology in a way that no mining companies are doing so far.
Okay, like, and again, you're not a VC rescuing technology companies. You're not a technology company. Ultimately, your value, the bulk of your value, I should say, is going to be predicated on what you extract from this waste, for sure. How does that go up against existing tailings and waste processors that exist in the market? So they're not many, but there are some.
The world's a big place. As I said, there are 10,000 closed mines in Canada. I think when I was in Australia last year, they told me there are 20,000 closed mines. I think it was in Queensland or New South Wales, although most of them will be very small. So there's lots and lots of opportunities. I mean, we're very happy to have other people doing this, because this is a new category of tailings management, urban remining, and I think it's going to have more and more profile going forward. I think people saw waste as a waste or as a liability. I think in the future people will see it as historic heritage. But we also are working with other waste providers to see if we can bring our technologies to them and collaborate with them as well. So we're very flexible about how we work.
Okay, you talk about maybe 20 by the end of the decade, five now, 20 by the end of the decade. What does that, where does that put you in terms of whether you want to go on EBITDA or NPV, how do you want to value this company? What's the opportunity ahead of you?
Well,
How do you value it?
if you take Lakshanine, which is just the first one, the cost is very little, and the NPV we think will be 130 to 150. If you do that 20 times, you're talking $2 to $3 billion. As I said, just the magnet recycling business, our 60% stake in the US business, we have 20% of it globally as well. If we did just 3 sites, that would be, again, $1 billion. So I think we have the ability to scale a multi-billion-dollar business, and we are just going to execute, and that's what our focus is. That's the story.
Okay, so and just okay, the copper, which I love, iron ore, fine. Rare earths at the moment. It's getting a really good hearing from U.S. government, Department of Defense, Department of War, and companies that have been have received been the recipients of cash equity and offtake from them have done exceptionally well, trebled and quadrupled in price. How does the US fit into your messaging and your story? And can you take advantage of it?
We are in very extensive dialogue with the Department of War and the White House, and we're explaining to them that recycling is a very good Plan B insurance policy, because the Plan A has all sorts of technical challenges, and our recycling is well proven and it has much less risk and much less steps, etc. So we'll see where those discussions go. But we're also talking to them about how we could use our technologies to unlock the tungsten and the vanadium and the manganese, etc., inherent in a lot of the old waste sites that the Department of Interior and the EPA have inherited. So that's another discussion that's going on. Plus, in our iron ore business in Minnesota, we will be making pellets in the US, and we're also looking at ways in which we could then turn that into pig iron in the US. Having a domestic source of that material is very strategic as well, to make sure that the appropriate qualities of steel are going to be available going forward. So we're having a dialogue with them on multiple fronts, and I think they're very open to looking at technology, as we know, but also looking at recycling and stopping the export of this heritage material from the US.
What's the kind of barrier to entry here? Because I've had a few companies come on and try and do the same thing. I think their problem was access to capital. But in terms of for you, what protections are there to stop people coming and trying to imitate what you were doing? Was it the selection of the technology? Is it the access to the capital? Is it acquiring the right sites?
Well, I think we have a lot of different things. Initially, fortunately, we have capital ourselves, so we don't have to rely upon that. And I'm very happy to finance CoTec, as I've been doing. Secondly, we selected technologies which I think, as I said, we looked at 400, we've invested in 6. So we were very, very careful about ones which we felt really ticked a lot of boxes, and also that those technologies were patent protected, so that there are some barriers to entry. And then building on those advantages, we're now looking to hoover up the appropriate waste sites in a sort of land grab. But you can only do the land grab if you've got the technologies, which are the key. So that's the way in which we're doing. And we're very happy to have competitors. As I said, the world's a big place, but hopefully by the time generally people wake up to what we're doing, we'll have got a lot of the best sites for the growth ahead.
And how many frogs do you need to kiss, and how long does it take to actually work out whether the technology will work?
Well, you do testing before you commit to the asset. So that's what we've been doing. There's laboratories testing the geology with the technologies to see that if they're going to be successful or not. And then once you know that it works, then you can move ahead. But it takes a while even to find a potential site, negotiate an agreement for them. I mean, as I said, I hope we can do our first copper deal by the end of this year, but we've been looking, for copper for 18 months. Generally, after we buy technology, it probably takes 1 to 2 years to find the first opportunity, and then you can start to cookie cutter that and roll it out more rapidly.
Okay, interesting. So a few barriers to entry there. Well, look, Gillian, appreciate that. Really enjoyed hearing that, and I understand it better. And the road ahead is clear. So appreciate your time today. Please stay in touch.
Always a pleasure to chat to you, Matthew. Thank you for your time too.